Well, I've recently returned from a trip into the US where I spent time with government officials, with Federal Reserve officials, with real money managers, which are our customers both on the East and West Coast, and with other economists. The overall view at the moment seems to be that there is a high degree of uncertainty in the world. Clearly, the well-documented issues with sovereign risk that is now focusing on Greece and the southern countries in Europe, but may well spread to other parts of the world, particularly those parts that don't have the safety of the Eurozone to support them. Second area of uncertainty relates to China. I was quite surprised at the degree to which these global investors are concerned about the outlook for China. Basically focusing on the fact that there's been such a huge surge in credit, that's likely to have created inflation risks, asset price bubbles, excess capacity, and a surge in bad debts in the banking system. And how China deals with those issues is worrying international investors. The third area of concern relates to the US and the Federal Reserve. How will the Federal Reserve deal with the current concern that inflation is going to take off in the US, as indicated by the rise in US long-term interest rates? Will the Fed tighten too early? How is Washington coping with dealing with the crisis? Is the concern of over-regulation going to affect the capacity of the US economy to recover? The signs that we'll be looking for the US economy to recover will very much centred around the labour market, the availability of bank lending, and the recovery in the housing market. Big question marks about all of those three. We have seen a fall in the US unemployment rate, but we need to see some further follow through there to be confident that the unemployment rate is on the way down. We've seen big falls in bank lending in the US. Is it a supply issue or is it a demand issue? Are the banks just unable to accommodate further demand, or do people just not want to borrow? Now, it's a combination of the two, but I fear that there's a high degree of supply constraint there, which means that even if households become more confident, if the unemployment rate stabilises, and then people feel that they're in a better position to spend, if the credit isn't available, then it's going to be very difficult to finance a US recovery. This problem of credit is also very important for small business. Big business in the US seems to be fairly well cashed up, but small business does have these problems. So at the moment, high degree of uncertainty around the globe, and I don't believe that augurs well for a strong, sustained upward move in equity markets. We've seen a very strong recovery in equity markets since the lows of a year ago. My view is that equity markets are likely to be hampered by this uncertainty and likely to go sideways for some time to come. Of course, for Australia, the critical issue is China. Will China be able to deliver a soft landing? I'm confident that they will, but I was surprised about the degree of uncertainty that we're seeing in international markets. For the Australian dollar, clearly the outlook for the Chinese economy remains critical. If it wasn't for the uncertainties about China, Australia would be able to adopt a role of a safe haven at the moment. Global investors who are getting concerned about the risks in Europe, getting concerned about some potential imbalances in other emerging markets, would see Australia as a great safe haven. But while the question marks are hold about China, then people are a little nervous to surge back into the Australian dollar and into Australian investments. The Reserve Bank raised interest rates earlier on this week. Rates are still about 0.5% below what I would call neutral. It's very clear that they will be heading towards neutral, I believe, at a faster pace than the market is currently expecting. A few months ago, we identified 4.5% as being the target cash rate for the end of this year. The market had 5.5. The market's now scaled their views right back and are only really looking at one interest rate hike between now and July. We think there'll be two. We think there'll be a pause, but all the risks are around the pace of improvement in the labour market. We assess that the NAIRU, which is the rate of unemployment below which you start to get inflation, is around 5% in Australia, bearing in mind that the unemployment rate has fallen from 5.8 to 5.3 in the matter of a few months. And the labour market numbers continue to surprise analysts, including ourselves, at the pace at which that labour market has been improving. A continuation of that pace over the next few months will find a very nervous central bank indeed. The other issue relates to the housing market. At the moment, we don't think there's a housing bubble in Australia. House prices are certainly up 13%, which the rest of the world would be, apart from China of course, would be very, very grateful for. But housing credit growth is only around 8%. We're not seeing the sort of hype and spruiking about housing at the moment in the media. The share of new loans to investors is only 35%. So at this stage, it doesn't appear that we've got an emerging housing bubble. But that could change, and if that was to change, then the central bank will have to take action. Given the recent adjustment in attitudes towards monetary policy by central banks, that they now need to take into account asset markets and not just inflation. That could be another factor that could have the Reserve Bank moving a little more quickly than has been our long-held view. Thank you.